well, let's get started. Why don't we actually introduce, I'll have the panelists introduce themselves, and then we'll get started talking about the future economic model of the advertising industry and everything in between. Miles, why don't you begin?
I'm Miles Nadal. I'm the chairman and CEO and founder of MDC Partners.
Alexia Quadrini. I'm the advertising analyst at JP Morgan.
I'm Jordan Brohan, former Wall Street analyst and now managing partner and founder of Clear Meadow Partners, an advisory firm.
And I'm David Faber from CNBC, and I'm looking forward to learning a lot about the advertising industry in the next 40 minutes. So why don't we start there? Miles, lots of industries like to describe themselves in the midst of dynamic and important change at a seminal moment, it seems, with so many different industries facing the digital future. Is that also the case for advertising?
Well, I think there's two things about that. One is there obviously is a transition from persuasion to influence. So obviously traditional media, the movement toward social media and interactive has been very pervasive, and it has obviously caught the attention of clients. In addition, the economic slowdown that has happened has had dramatic change on budgets and changed the expectations and expectation of quantification of financial return on marketing investment expected from agencies. It's also been an industry that has been privileged to have had growth for about 20 years, anywhere from 2 to 8% growth. This year the industry is experiencing 14% decline in growth, and in a fixed cost driven business it has been very hard for most of the participants to cut their way to success. So as a result, you've had huge declines in profitability. There's also a very big market share shift from the big multinational networks to smaller, more entrepreneurial firms, where the most prolific ideas seem to be resonating from, especially those in the areas of influence of interactive and social media innovation.
Alexia, is the current economic climate, the decline that Miles just described, is it forcing the firms you cover to think about changing their model or actually begin to change their model?
I would say that the advertising holding companies in general have been evolving their business model for quite some time. I mean, if you look back at the agencies, they've been investing in newer media. I mean, back in sort of the mid-90s, look at Omnicom, for example. They were the incubator of a lot of digital advertising firms, way ahead before anybody really even talked about the internet the way they do today. So I think they've been evolving for quite some time. I would say the economic environment has maybe, if anything, slowed that a little bit because the focus is much more on cost cutting and reducing that overhead and sort of getting through this headwind. But I do think it'll pick up again in 2010.
You agree with that?
Sure. I think there's an added factor, though, that makes it of greater urgency to figure this all out. And that is the impact that Google and other digital marketing, advertising services companies whose business models are based on results of some sort, whether it's a lead, an action, a click, something that's measurable. When the budget shifts to over 10% of total advertising being digital, and all of that is more measurable than a lot of the traditional media, it puts added scrutiny and heat on those decision makers who are in charge of the media mix. How do you defend in a tough economy putting more money or more campaigns on TV when in fact you're not sure how many more Toyotas or Whoppers that might have sold? When that happens, then those people directly involved in the production of those commercials and all those things, they have to quickly retool and say, I can do digital too. That takes time. And it's very hard to adjust in a reasonable amount of time.
The reality is 90 cents of every dollar today is still spent in traditional media. The biggest challenge facing most of the multinational networks is that in order to evolve and in order to retool, you must reinvest. Most firms are not in a position to be able to reinvest. They're trying to maximize quarterly earnings and cash flow. So they're not prepared to make the changes necessary to get rid of the 10 or 20% of unused real estate, to get rid of the older personnel who are not digitally savvy, who don't really understand how consumers consume influence in a digital economy. If you started from scratch today, you would not have 72 offices in 54 countries. The internet has leveled the playing field that you can be a firm with global clients in 2 offices. or 3 offices. So the infrastructure that is a legacy infrastructure, it's very hard to dramatically change that. You can only modify it, and 90 cents of every dollar is still going to traditional media. I don't believe that we've adopted a dramatic transformational mentality as an industry.
But Miles, wouldn't you say that one of the reasons 90 cents of every dollar goes to traditional media is because the advertisers haven't really pushed so hard to make that change? Or do you really think it's the holding companies being a bit antiquated and therefore not having the capabilities to make the change?
It's a very good question. I think it's both. First of all, if you want to have behavior in life, you should create economic rewards that reward that behavior. We as an industry don't want that change, right? It was easy when you got paid 50% commissions and all you had to do was do TV spots. That's very lucrative. To do viral marketing, to do interactive, to do social media, we haven't figured out the methodology for billing to get paid on the same basis and to get paid, so the profitability of those businesses is not the same. In addition to that, I think at the feedback we've had from clients is that historically agencies led clients as to what to do. Clients now are very frustrated and saying, you know, we need innovation and we're not getting that innovation from agencies, and that's why there's more shift from big multinational firms to smaller, more entrepreneurial firms where that kind of big idea and thinking is coming from. But it's going to evolve, and it's happening. I mean, Jordan, you were the first guy to recommend Google, you know, 4 or 5 years ago.
Jordan, in terms of the idea that more people, I would think people spend more than 10% of their time on the internet at this point of the various things. And yet, as Miles has pointed out, only 10% of the dollars are flowing to that. Is that surprising to you? Are we going to reach some inflection point where suddenly it flips very quickly? Or is it going to continue to lag significantly time spent?
I think if you ask the owners of local stations groups and billboards and other categories like that, they'll tell you it's happened pretty quickly. We're in the midst of it right now. If you look from any one year to the next year, you may not see the trajectory that you're really on. But if you look over the last 5 years, it's been quite dramatic. You know,
even getting just to 10% has been dramatic, really?
It's been a faster adoption, historically speaking, than radio, TV, or anything else that has come before it. And I'm talking about the category of digital, and specifically response-based digital advertising, which I think is unique in that it's hard to debate the merits of doing it. It's just a question of what you're willing to, what resources you're willing to.
Alexia's shaking her head.
I think the move, there has been a pretty quick move, but I think in some ways it might be stalled. And before you disagree with me, let me explain what I mean by that. I mean the advertisers, I think, want to put more money on digital. The consumers are obviously spending much more time on digital. But I think the advertisers, and you guys correct me if I'm wrong, the advertisers are struggling on how to do it effectively. I mean, they know display doesn't work. Search works definitely, but for a certain function. And I think they're all struggling, saying, you know, I need to put more money in digital, but I don't really know how. And I think they're looking to their agencies, and some of their agencies are clearly coming up with some good ideas. But I'm not so sure we're going from 10% to 20% because I don't really know how they quite do that.
There's another point that we're really completely missing. You're only talking about measured media, but social media is not considered measured media. So there's all these dollars that are not being quantified in YouTube, MySpace, Facebook, Twitter, etc. So there is...
YouTube is considered social media? No, YouTube would be part of Google. That would be counted.
No, but it is part of social media. But let's take the most successful marketing campaign. So I talked about persuasion and influence. So the election of Barack Obama was the most successful marketing campaign that I can remember from my perspective. They recruited 14 million brand evangelists on the internet to raise $400 million in 9 months, deploy $300 million on television, measured it every day, massaged the message, and ultimately got him elected. So what do you attribute the success to? Was it the 14 million people you recruited on the internet, the $400 million that you raised through over the internet, or the $300 million worth of television advertising that was being used to actually get the message across and to get them elected? It was the combination of those factors. So going forward, I think it's going to be the ability to use both traditional media and social media and interactive, where you sort of have the interactivity of the brand hanging out with the consumer and vice versa, that you're going to actually be able to deliver actionable strategies that are measurable. I mean, ultimately, we're in the return on investment business. And we as an industry have never had to be accountable. You think about, you're on Squawk Box in the morning, you think about, everybody on your show marks the market daily. Think about sort of what would happen if you had 4, 6, 8, 12 quarters worth of negative performance of any manager who shows up on your show. They wouldn't have a lot of clients, right? So the measurability of impact is coming, it has come, and it's now being demanded. And I think the compensation model will change accordingly, where it'll be much more like the hedge fund model. You'll get paid for the cost.
You hope it was like the hedge fund model.
No, actually, no, that's not true.
I don't think 2 and 20 is coming to your industry, Miles. I know you want to run a hedge fund.
I love it. I love it because it'll actually, it's Darwinian. The people that will actually produce the results will get paid handsomely, and those that won't will falter and die. So it'll ultimately show the wheat from the chaff in life.
That would be nice, right? In the hedge fund industry, even those who die with $60 or $80 million. But yeah.
But the concept of pay for performance,
right,
is very different today. It's not the concept of pay for performance that we as an industry requested, which was to get incremental compensation for the value we created. This is being requested by clients who sort of say, I don't want to pay for the time you put in. I want to pay for the value you create.
Understood.
So I'll cover your costs, but I'll give you upside potential based upon quantifiable performance metrics.
And I want to get to that, but I want to let Jordan.
There are a couple of key points. I happen to agree with much of what has been said, possibly not the hedge fund comment, but a few things. First of all, attribution is a industry-wide debate in every segment of media and advertising that I address in my business today. And the reason is because it's not, you'd like to say it's science, and certainly there are algorithms in place to try to estimate it, but it's very difficult to discuss whether a billboard or a radio ad or a television commercial or a print magazine ad or a search keyword, how much of that conversion, that new customer, was really driven by each of those things. And so as much as we'd like to be completely results-based, the only guys who are possibly making too much money on each click are Google, because they're all the way down the funnel. Everybody else is trying to convince the advertising community that they should look at other metrics. It's hard. It's very difficult to argue with that last click attribution model. Second, when you take the world and you start to focus on social media, it's hard to express a budget for any big advertiser there. There aren't a lot of places to spend money today. I recently gave the analogy that social media is a lot like Central Park.
But they're going to figure it out, aren't they? At some
Well,
point.
eventually.
I mean, certainly there are a lot of people who've invested in Facebook who believe they will figure out a way to monetize.
Well, I won't speak for those that have invested in Facebook. But
well,
I will
I'm just
tell
saying
you
they
that
have
the social
attributed a market
utility,
value that could be as much as $10 billion to
there
this
are
company
many-
that has very little in terms of EBITDA, cash flow,
Right.
or revenues.
Right. Now, Facebook's user activity levels are extraordinarily high. There was recently a study that said that 65 million people out there check Facebook via their mobile device every day.
Right.
And 275 million people in the world are looking at Facebook on a regular basis.
That would be
More
a-
engaged with that than any internet business that we've
It's a pretty
seen.
robust platform, one would
That's
think.
right. So the ability to either persuade or influence people using that social platform is extraordinary and something that we can't quite put a price tag on. You know, Microsoft put a price tag on it, some other investors put a price tag on it, but it's hard to value that amount of influence and persuasion.
I do agree with what you said, David. Ultimately, somebody will crack the code to figure out how to monetize that. Whoever does will become very wealthy.
Any ideas here? Anybody?
I have a feeling my guess is the Facebook founders, right? That's really what we're talking about here. There's only one Central Park in New York City. It's a tremendous place to hang out with friends, you can throw a Frisbee. You're not going to spend a lot of money there. And that's the toughest part of, when you look at the internet right now and you look at, say, the ad network business, it is awash with Facebook inventory everywhere you look. They have billions of page views that nobody knows what to do with. Reasonably, the only page views that matter for social media are the first 3 before you really got into something social and interactive, and the last 3 before you exit the platform, because that's when you're more receptive
So you're
to a
not
marketing
convinced
message.
that they'll ever figure it out?
They will. It'll be slow. It'll be incremental. They'll do over $500 million in revenues this year. They are figuring it out.
Right.
But don't expect the intermediaries and the agencies to be able to make a ton of money on it. There's no guarantee of that.
You know, when you talk about accountability and measurability, you're talking about it on a per click or per item basis on every single thing you do. But the reality is what marketers really want to know is over a period of time, how has the impact been? Am I selling more burgers? Am I putting more people through? Is my average sale greater? Am I gaining market share? Not everything you do has to be quantifiable, but over the course of the year, the metrics don't lie in terms of financial performance.
Chuck, the model you're describing, where the ad agency is paid essentially an incentive fee, would demand those kind of metrics, right?
Well, yeah. I mean, it goes back to that you'll get paid a lot less than you did on a base basis, but based upon the success. Like, I wish that CPB was paid on Coke Zero for the performance. I would have taken, and I would have underwritten personally the base compensation if we could have just been paid for the 40% growth in share that happened over the last few years. Look, Chuck Porter told me a story once. He said, look, when we took the BMW...
He's here, he could just tell us himself.
It wouldn't be as good, actually. I tell it with more embellishment than he would. They had the BMW Mini business. They put Minis on the cabs of Ford Expeditions and they drove them around cities. And the Germans came up and they said, we want to measure the impact. We want to see, is this a good investment of time, effort, and energy? And at the end of several days, they basically said, we don't know if we can measure the impact, but every single stoplight we get to, everybody's pointing and looking at it, and it seems to get a lot of recognition. Ultimately, over the course of the period, they sold out all the inventory throughout the year for several years. Same thing was true, by the way, at Coke Zero when they did the online campaign with the lawyers. You know, it didn't test very well. They actually ran the campaign. It was exceedingly successful. So some of the things you got to do, you just got to throw. I mean, Nike's one of the great organizations that just throws brilliant creative ideas at brands and tries things, and it obviously seems to work.
So you basically, you support the model of going completely to incentive comp as long as there's some coverage of your fixed costs? Because I just want, what about the client? I mean, you gave two great examples where you've been very successful, but what about the client where there's some, you know, extraordinary factor having nothing to do with your creative work that, you know, hurts the sales of the product, and does that mean you guys don't get paid?
Oh, first of all, I know where the world's going, whether I like it or I don't like it. It'd be nice to be paid for whatever you did, no matter what happened. That would be nice, okay? But that's not the reality of the world. Corporate profitability is under siege. Costs are under siege because revenue is not growing for most firms. So I say we have a choice in life. We can either embrace change and be, as Bear Bryant said, mobile, agile, hostile, or we can sit there and pray. I never saw prayer as a strategy. I say we need to get ahead of this. So my notion is I think that more of our own internal costs have to be more variable. I think we have to be in a position where we need to demonstrate quantifiable success, and we need to be in a position, if we're going to take that risk, to be able to go to clients and say, then give us the upside potential. But the reality is we don't have a choice. The clients are demanding it, and that the movement's going to go that way whether we embrace it or not. So I say let's embrace it. And ultimately, economics are very efficient. If you can deliver value, clients will find you. The best opportunity that exists right now is the market share shift. There's still $600 billion being spent. I mean, the firms that are growing right now are growing because they're taking share.
Jordan, on the digital emergence at ad firms, you've written that the complexity has increased. That is, the complexity of offering a product for advertisers, I guess. But the fees advertisers are willing to pay have decreased. That doesn't sound like the kind of business that you want to be in.
Right, and let me expand upon that a little bit, if I could. So to everybody, the idea that complexity increases makes a ton of sense, but let's just examine what it was 20 years ago. Essentially, you had between 4 and 20, depending if you had cable in your neighborhood, number of channels to reach people on. You had geographic targeting for local media, newspapers, print, and other forms of print, radio, billboard, such. And today, you go everywhere with your mobile device. You can be anywhere logging into the internet. on any website, which may or may not have accurate cookie information tracking you all over the place. They're measuring you behaviorally. They're measuring you from a contextual point of view. They're measuring you based on past transaction behavior. Even if they wipe out your name, they are looking at when and how long you're spending on certain sites and what sites you're coming from. If you're going to and from Facebook, they know it because they're putting pixelated indicators on your web browser. And this is all supposed to be done by the same set of agencies and brand stewards that were doing it before. And it's just very, very difficult and complex. Now, are they going to pay more for that? I doubt it. Because at this point in the economy, the threat to a big agency holding company of losing a major client is too great to absorb. They would rather absorb a reduced margin or reduced payout in the short term and not have that big corporate disruption of losing their brand name client. So they'll take the punishment today. If there were no fear of loss and there were new budgets everywhere and growth in the economy, the agency world would be able to fight back a little bit more because they could fire their clients and find some new ones. That's not how things are going today. So some of this is just the margin impact on a really tough economy on these agency holding companies. They're in a tough spot. They have a lot of fixed costs, as Miles said.
I agree with most of what you say. I think the difference is that when the dollars move from traditional media to some sort of digital platform, I think the agencies assume a lot more of that revenue stream. They're not paying for expensive media on prime time. They're not paying for talent, fancy directors. You know, they're doing a lot of the work in-house. And I think you're right. I think the more fragmented the business gets, the more work there is to be done. But I think if they're actually assuming a lot more of that share of those billings, you know, ultimately they can make some good profit dollars off it. So I don't think it's necessarily a lose-lose situation. I think there's an awkward transition period, but I also think who else is going to do it for the advertiser?
Okay.
Well, there's two. The other thing is we've talked about media and measurement. We have talked nothing about creativity. This business is, and always will be about storytelling, about brilliant ideas that have an emotional connection between the consumer and the brand. And those people that could tell a very compelling story will ultimately have the ability to deliver results,
regardless of how it's distributed.
Absolutely, and
even if it's on my BlackBerry.
Well, there'll be many different different means of distribution, and one won't replace the other. It's all additive. Yeah.
Can you find people, qualified people though, who know what they're talking about in the digital arena?
Absolutely.
Can we want to work for an advertising firm?
Well, Jeff Benjamin told me that 6 years ago he was one of 4 people, and now there's 250 people that are just in digital at one firm. I mean, we would find, if we could find 500 more, we would. I said the other week, if we could find 500 social media experts, I would go hire all of them at once.
You would?
Absolutely.
That doesn't sound like a good investment.
Why not?
Sounds like an awful lot of people who would all be thinking the same way.
In 2001, you know, there was a little firm, and it had, I don't know, about 100 people, and now it has 1,100 people, and we always hired ahead of the curve. And I believe in the field of dreams. If you build it, they will come. To me, the limiting...
Panelists are laughing at you.
I like that.
But they're not talking.
I'm just smiling. Okay. I'm not laughing.
I'm sorry.
No, but it's true.
What was it that made you smile?
The most talented people produce the best ideas, and the clients follow the talent. They have and they always will. And right now, what's happening is there's a huge shift. It was interesting.
There's a huge shift. What's the shift?
The shift is away from big firms to smaller entrepreneurial firms. Lori Senecal, who just joined us as a named partner at Kirschbaum Bond Senecal & Partners, she said to me, $3 million is the new huge. She came from McCann. So, like,
Alexia, is that true?
I would say that, I think you're right. I think there's definitely a resurgence in some of the independent, smaller shops because I think some of the great creative ideas are lost in the big shops that keep doing the same thing in and out, and they're more frightened about losing that client relationship than being innovative. So I definitely think you're generally correct. I think it's also very difficult. I mean, I've covered this space for about a dozen years, and my biggest surprise covering this space is how slow things change, how slow advertisers are to make a change, how if they're unhappy with creative, you know what, they try it again, they try it again, they try it again. So I do think there's definitely the opportunity where there's a few clients that do quickly move, they're not happy, but a lot of clients are sticky. and they stay with things for a long period of time. So I guess I agree with you on the premise, but I don't think it's that drastic of a shift, at least not yet.
Until it happens. The big financial institutions used to be in the money management business. The biggest money managers in the world were Citigroup, Bank of America, JP Morgan, Merrill Lynch, etc. They have zero share of that market now. They're not in the money management business anymore. Okay? So for 25 years they were in that business. They don't exist in it. They've outsourced all of that activity. They've sold off their operations. They're now in the distribution business. I would say I think it's happening on a more prolific basis. Here's my prediction. Watch what
JP Morgan is still in the asset management
Sure.
business.
Small,
They all are.
small.
Citi,
But if you take a look, my interesting thing will be watch what happens to the car companies and all the agency activity over the next 24 months.
But who wants the car companies? I mean, is that a big coup to win all the car business?
I don't know. It was one of the largest advertisers in the whole world, and it was always dominated by multinational networks. Let's see what happens
I shouldn't speak
forward.
because it's obviously still a very big category, but it's under tremendous challenge. And, you know, the revenue's declining, the margins are being squeezed. From what I hear, the managements are being increasingly difficult. I'm not saying it isn't a coup to win a big car account, but I think it's not what it was 5 years ago.
No, but no business is. There's not any business where you aren't under siege to deliver performance. If you show me one of those industries, I'll pay you for the referral, because I'd love to find those opportunities.
Yeah, but there are better clients.
They're better clients than cars.
I want to, if the audience has some questions, think about them. I'll turn to you in just a sec. I did want to follow up, though, on this incentive, the idea of incentives, and I know Coke has begun to really move down that road. Do you think it's a viable?
I think it, I mean, I sat through the entire Coke presentation, you know, last spring at the ANA conference and listened, really tried to understand their business model and their proposition about moving to this more incentive comp model. And Miles, you work with Coke directly, so you correct me if I'm wrong, but it didn't even sound like they wanted to cover the fixed costs. They wanted to basically, you know, give you a little bit of money and really make it very incentive component. I mean, most companies are all incentive. And I just think it's very nice in theory and very difficult in practice. And if you're saying, what you're saying is maybe that's true, Alexia, but that's where the world's going and you need to embrace it rather than fight it. I mean, I think maybe you'll see a few more clients jump on that bandwagon, but again, I don't think it's going to wake up one day and everybody's paying all incentives.
I agree. It's not feast or famine, and I'm not saying the exact model that they propose is where they're going to land. I think it's a philosophy. I think marketers are angry because they feel that they haven't been given the value they've paid for. So you have this pendulum shift. There will be an equilibrium where it will be more moderate and people will have to earn their compensation and they'll get paid for the value they create. So I'm not condoning that model exactly, or the exact parameters.
See some compromise
I
come
just
out
say
of
there's
it.
a direction. The direction is a lot more accountability.
But you probably remember 10 years ago, P&G talked a lot about this too, and I don't really think that much came of it.
But you had a growing economy.
You
You
had a
had
better
positive
environment.
GDP.
Okay, that's fair.
You didn't have 14% decline. You didn't have, you know, the risk of a depression. You didn't have credit markets freezing. You didn't have, you know, negative growth in sales of every industry.
We all know how bad it was, most.
Say again?
We all know how bad the
Yeah.
economy was. It's
It's been a good 2 years. Yes, how about right there?
So I've heard from a bunch of people on this panel and other panels that there's a pendulum swinging and it's getting harder for everyone, and that the margins are all squeezed. I've also heard from almost every panel and from here that it's a pendulum and that one day it'll swing back and things will be better. It seems to me that it probably won't ever get better, that the incentive compensation was just about making sure those margins are smaller forever, and that the ad industry business is just under unbelievable pressure and it'll never be the same again. I'd love to hear what you each think, whether it'll ever get better or it's just going to continue to swing to a point and then stay there and continue to be very, very difficult.
I apologize. I hope I didn't convey that. I click my heels when I come to work every day now. I've waited 4.5 years for this. I think there's better opportunity now than ever before. I think that's not true. I think there are firms within our stable that are making more money than they've ever made. We will have a record year this year. I think it's about capturing share and delivering. I think it's a better opportunity than ever to attract talent. And I think if you're really able in terms of talent and you can deliver, I think there's better economic opportunity for talent. So I just say you can't rely on the old model and expect the old results. It's about a new model and a new approach to deliver performance, but I think you can get paid for it.
Alexia, your job is to determine who the winners and losers ultimately are. And so many industries that I follow are facing these same challenges that the digital world brings on them. But are you starting to get that sense? When do you think you finally do get that sense as to whether the pendulum is swinging one way or the other for so many firms?
I think when you're sitting in a dark hole, it's hard. It's sometimes hard to see, the other side. And I do think things get better. I think the advertising market does, at some point grow again. I don't know if it ever, has the kind of exuberant growth that we saw in the late 90s. I don't know if it'll ever grow at a higher rate than GDP growth going forward, but I do think we'll see growth again, and hopefully not too far off. With regards to the challenges going into the industry and how the agencies or other media sort of fare through that, I think there'll be winners and losers. I think Miles made a great point later. If you have a great creative idea and a great talent, you're going to make a lot of money in this industry, in the agency world. I think the change is you don't just make money by showing up to work anymore. I think the advertisers, are going to be more demanding. But in a better economic environment, I also think people kind of forget about all this and you go back to the old ways more than you kind of think you do. You take like a couple steps forward, maybe one step back. And so I don't think it's going to be drastically different, but I do think we are migrating to a different model. And with regards to other media, I mean, we say at JP Morgan, they're clearly people on the winning side of what's going on out of home, cable nets, digital. People on the losing side, print, radio, local TV to a certain extent. And I think that will continue to be the case coming out of this.
The other, just to add to what Alexia said, even when we get 1 to 2% growth back in the industry, which advertising spend usually mirrors GDP growth, I don't think the accountability and the psychology that marketers have about demanding accountability and looking for more for less is going to change.
Right.
I have actually, if I could, I have a follow-up question to that, which is, you didn't address the absolute total value of the advertising dollars. So we've heard about shifting analog dollars to digital dimes. Is there anything to say that when the dollars shift where the impressions are, that it'll be at the same dollar level? Because you just talked about growth. You talked about who wins and who loses and what the margin is. But is there anything to say that the levels are the same?
And there's...
Yeah. I mean, I think that question basically is, Jeff Zucker, my boss, has talked about, and this is a challenge for all media companies, dollars to dimes, which I would assume impacts the amount of money that they're willing to spend, that the advertisers are willing to spend on agencies and everything else. Does it ever get to parity?
I know it has to get better than this. Okay. So I agree with the assertion that it may never, you may never recover all that you've lost. What you've lost more than anything is the attentiveness of the consumer during periods where that consumer is in front of a TV or something else. That attentiveness is not likely to return. There's an entire generation of people that don't go anywhere without staring down at their BlackBerry or their iPhone. You can see them walking all around Manhattan, causing many traffic accidents. I know he's one. He's addicted to his bike.
I don't drive anymore.
Yeah. But that very much applies to what the behavior of those people, even when they're watching TV. It's often not based on an appointment viewing. They might have recorded that show. They may be paying less attention to ads, and there are fewer ads sometimes in what they're kind of also looking at. And I think that is the key variable that doesn't return. Sometimes an audience becomes more elusive. I would suggest that some of the problems that Viacom's MTV Networks unit is going through right now is that their audience is becoming more elusive. They're elsewhere. It's harder to reach them with cable programming. For Viacom, it's not clear to me how quickly they can recover that. Clearly, they can have some hit shows where they haven't had hits in the past and get a little bit. But overall, that trend is very, very compelling and irreversible.
But the number of dollars is not coming down.
No, so. And it's not going to. Yeah. Dollars spent on marketing will be a reflection of sales of companies. Harvard's done a study for years and years that said companies that maintain or increase marketing spending in difficult economic times maintain or increase market share. Ultimately, if you have 1 to 2% GDP growth, you'll have 1 to 2% dollar growth. The difference is they'll be looking for much more bang for their buck. So they'll be getting, if it's a $600 billion industry and it grows 1%, then instead of being $606 billion, it'll be effectively that they're getting $630 billion worth of purchasing power, okay? But if you said to me, do I think we're in a declining advertising world for the next 10 years? Not a chance. As you get growth in sales and corporates, revenue streams continue to grow, people will still spend a portion of their revenue on marketing. It just will change in terms of the mix,
right,
and they'll get more dollars of impact.
Sir.
Yeah, thanks. Could you dig in a little bit on this rosy future for social media? There's a couple things I'm not so sure about. I'm a little antisocial. So there was a correlation about time spent with media and time spent with the advertiser following that time spent. But that correlation isn't really there. 29% of consumers' time is with radio, only 10% in the ad spend, sometimes less. 6% of people spend their time with magazines. Magazines get 16% of the dollar. So that's out of correlation. Twitter has a 20% retention rate after the first 30 days for their average user. So they're losing 80% of the trial. And then lastly, I'm just not sure what happened to GeoCities, the 4th most visited site in the web. I just wondered if you could dig in there.
I can handle the web question. So.
Go ahead.
Listen, I'm not going to try to pick on each of these points. We can talk about it afterwards if you want. But the specific theme that you're addressing, which is that web properties come and go, particularly those with low retention rates overall, that in aggregate, when you look at the utility that the web provides, it's going up. And that value may go from GeoCities to MySpace to Facebook, possibly to Twitter, but the percentage of people who are doing something social on the web is going up. My mom just got on Facebook 3 months ago because she was sick of my in-laws seeing pictures of my son without her seeing pictures of my son. And I don't know if that's necessarily the driving factor for everybody else. But when my mom does something, that means that 2/3 of the rest of the population is already there. That's just kind of how it is. So you may be antisocial today, but over time, you're going to find yourself becoming less antisocial, I believe. And when you do, there will be something popular that's made for you. It may not be the expose everything world of Facebook, which I agree sends shivers down many people's spines. But it may be something only slightly social, which can fit your personality type, if you will. And over time, that utility of the web as a whole, it'll adapt to you. The web is very low cost barriers to entry. That means people can try out things and see if they work very inexpensively. And eventually, somebody's going to find something that works for you.
Also, you want to make it very scientific in the short term. Our job as a creative organization is to make brands relevant in pop culture terms. So if Twitter is a relevant distribution vehicle, we need to induce trial. We need to see what happens. And we need to try these things. And we're pleasantly surprised.
So how do you resolve the correlation issue with the rest of the media world? Time spent and investment from advertisers are not directly correlated.
They haven't figured out really how to use social networking, how to advertise on social networking. Like we talked about before, I think they're beginning to. We're seeing real revenues on Facebook, but one day someone may figure it out, and you'll see a flood of dollars go there. And I think you may not see a one-for-one, because I agree with you. You don't see one-for-one in most other media, but you'll see something a bit more normalized.
There's not a marketer in the world today who doesn't say, I'm not comfortable that we are covering all of our bases on social media. I don't know what we're not doing, but I know we're not doing enough.
They want to be there, they just don't know how.
And I'm not going to pretend to be the expert on correlations between time spent and dollars spent, but time spent may not be the ultimate indicator of what's important to you.
Good point.
We have time for one more question. How about this lady right here in the front?
Hi there, Sherry Novick, Planet Soar. Miles, I'm not sure if everyone here knows about your very interesting and quite different portfolio strategy that's different to the larger networks. But you own gems like Crispin and advertising. You're talking about the importance, and I'm sure you'll be buying more digital, particularly social media. But tell us about your investments going back some years in innovation and design firms, as well as about a year ago, speaking with people in your organization, it was, we see plenty of growth in the US. We're not that interested, China, Asia, other regions, there's plenty of upside in the US. That's changed a lot since last year from an economic standpoint, but tell us more about your portfolio strategy and where you're seeing growth in some of these other sectors and disciplines that are not getting as much mention as social media?
We love design because we see there's a convergence between marketing, advertising, design, and the product. I mean, Alex Bogusky and John Windsor just wrote a book called Baked In, and it's all about how the product is the best brand evangelist, and the brand equity in a product is very powerful and unexploited. So, you know, we're very privileged to have firms like Red Scout and Skinny and Bruce Mao, et cetera, who really are secret weapons, maybe not so secret anymore. We've chosen to be in America because 50% of all dollars are still spent here, and we don't have global scale, okay? So at one point in time I questioned and sort of said, gee whiz, when Asia and all these emerging markets were growing 13% a year, you know, maybe that wasn't so smart. I kind of love America, you know, land of the free, home of the brave. It's been very good for us. I think, and everybody else going everywhere else, so I'll say stay right here. That doesn't mean we won't support Crispin Porter, Bogusky, or Kirschenbaum Bond, Senecal Partners, or anybody of our other firms who have broader geographic ambitions. But it'll be in relation to the demand from their clients. But right here in this marketplace, we think there's an incredible opportunity to capture share. Right now, we have 1% share of the domestic marketplace. I don't know, if we get to 2%, that's not so terrible. You know, all we need to do is double over the next 3 to 5 years. We'll do just fine. And so we've got a niche strategy. We're going in a different direction. That doesn't mean what everybody else does isn't a good idea. It's just not for us.
We have to end it there. Miles gets the last word. Miles, thank you. Alexia, thank you. Jordan, thank you. And thank you all for being here.